Good evening, friends. This is Rahul Magan here as a Group Chief Executive Officer at Regi Consulting and also a venture capitalist. Today at MBS, Marina Bay Sands, we're going to shoot a video about. This video is specifically for the pension funds, endowment funds, LPs, which is limited partners, general partners, and sovereign wealth fund (SWFs). Today we attended a conference by SWFI, Sovereign Wealth Fund Institute in Singapore, wherein I was speaker and I was covering about the private market. Now, one of the questions that emerges during this discussion is alternatives really an alternative? Now, this video which we are shooting is definitely shooting for the top people. This is for the elite people. This video is not for everybody. I'm not going to explain what exactly is an alternative. So, a few years ago, the pension funds, first of all, we need to understand that pension funds are facing the liability gap of $3.5 trillion. And as per multiple research reports which are in the public domain, they suggest that if the asset price, where the probability is very high, would shrink by another 20%, this liability gap might tune up to 4.5, it could be 5, it could be 6, it could be $7 trillion. I don't know. Time will tell, but asset price correction is mandatory. Now, pension funds were investing heavily in the mainstream investments. We have two types of investments for pension fund, endowments, LP, GPs and sovereign wealth fund is the mainstream and alternatives. But in the last several years, I personally feel that the alternatives are no more alternatives. The few examples of alternatives are real estate, hedge funds, private equity, venture debt and private credits. Sometimes structured credit also. I don't think that alternatives remains alternative because of the following reasons. Number one, approximately $10 trillion, the number which I got to know today from the magazine in our conference, that $10 trillion funding has been in an alternative. $10 trillion. Secondly, out of $10 trillion, only 10% of the money is in PE and VC segment, which is closer by $100 billion. And out of this 10% of money, 5% is by VC. So 100 billion into 5, which is 5 billion. Effectively, in alternative space, we have 10 billion. Out of this 10 billion, the VC and PE component is approximately 100 billion. And out of this 100 billion, VC component is 5 to 10 billion, rest $95 billion is the PE component. So who are the investors? Sovereign wealth fund, the pension funds, other LPs and other GPs. Where is the moral of the story? Is alternative an alternative? I would like to close this video, very short video as I made it for the elite people, with three questions. Question number one, if alternative is really an alternative, then why did the Nordic, which is the largest mutual fund, largest sovereign wealth fund of the globe, in the last quarter, why did they declare the result of 1.8%? And the AUM is more than $1 trillion. Secondly, if alternative is an alternative, why both Thomson Reuters and Bloomberg do not have the pricing models of alternative in place? I challenge both Reuters and Bloomberg. They open their terminal and in analytics section, if they give us one pricer wherein you will compute the value of an alternative. Third and very important thing is that how confident are the portfolio managers when they are investing in an alternative? Even in today's conference, one of the emerging questions that came by is that the portfolio managers are still little reluctant as far as their investments in alternatives are concerned. They are pretty happy as far as their investment is the mainstream is concerned. We need to appreciate that mainstream was history. Anyways, alternative is no more an alternative, so it is a part of mainstream. That's again a fact. To cut the long discussion short, we need to see that if you're expecting a double-digit return from any sovereign wealth fund, LP, GP, pension fund and private equity, then you are over expecting. And if they are generating you more than double digit return, then they are playing with the credit quality. That's for sure. And this was the common theme which we have today, that if somebody is giving you more than, and that I strongly agree that, if somebody is giving you more than in a double digit return, then he is playing with the credit quality. Apart from that, I would like to spend another half a minute and 1 minute on the consideration that today, I also got to know that these LPs, GPs and sovereign wealth fund and pension fund, they are not much interested in bespoke and quantos. I don't know, maybe they don't know, they don't understand the pricing. Both Reuters and Bloomberg, they do not talk much about bespoke and quanto. or maybe this businesses moved to Hong Kong from Singapore. We need to make sure that if we really wish to mitigate the gap of the duration, basically duration management is a liability gap are the two important, duration management, liability gap and the immunization are the three important pillars which we have. If we really wish to manage all these pillars together, we need to make sure very carefully that we need to have bespokes in place. Here, unfortunately, Singapore is losing some credentials in bespoke, and Hong Kong is gaining some credentials in bespoke. But Singapore, as a financial hub, need to understand one thing very clearly, that they cannot survive if the bespoke, exotics, and Quanto will move out of the Singapore. With this, Treasury Consulting, thank you very much. You know our mobile number 919899242978. You know our fixed income platform www.fixedincome.global. And if you think you have credentials in the financial market, if you think that you have something to speak, some credibility is there, you can write to us. We'll see if we can add you in our WhatsApp group. Thank you. Have a good time ahead.